Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 8th of August. I'm Daniel Lam, your host for the podcast. A key point that we made in yesterday's podcast is that the Fed funds rate is at a 23-year high, and the Fed has significant capacity to ease policy to help the US economy achieve a soft landing. But how fast would the Fed actually be cutting rates? Well, in times of extreme volatility like this, it is very easy to hear many panic statements from various parties. So today, let us put things into perspective. Now, at this stage, it is quite unlikely that the Fed will cut between meetings or opt for a sequence of 50 basis point cuts. Intermeeting cuts are reserved for crisis situations in which there's risk that the economy and financial markets freeze up. Yes, there has been pain associated with the unwinding of forex carry trades, such as the yen shorts, but that is far from a COVID or great financial crisis shock. Yes, equity markets were roughly 10% below all-time highs, retracing about 2 months of gains. But that's not likely to be enough to provoke dramatic policy action. There is a possibility of a 50 basis point cut in September, but we would need confirmation from other data. If other data confirm that the decline is as steep as the July labor data suggests, a sequence of sharp cuts could occur. If one looks at history, a good comparison period would be 2000 and 2001, when there was a sharp fall in Nasdaq 100. Back then, the data took a sharp turn for the worse ahead of the first 50 basis point cut. And importantly, looking at the side-by-side comparisons, last week's data was not as bad as what we saw back then, apart from the unemployment data. Of course, we still got 2 CPI reports and 1 jobs report before the September FOMC. But there's a reasonable chance that 1 or 2 of these may underwhelm the extreme dovish expectations. In the very near term, however, the focus will be on this week's jobless claims. If we don't see an uptick from the 249,000, then we may see odds of 50 basis point cut in September drift lower ahead of next week's CPI report. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.